New York Community Bank is in turmoil, raising all sorts of questions about regional banks. The regional bank closing Thursday at $5.75, down even further from Wednesday's worst single-day drop for that company. I want to talk to Liz Hoffman about this, Semafor business and finance editor, a CNBC contributor. Liz, how much are we supposed to worry about this, not just about this particular bank, but to the degree that all of a sudden are we back in the same soup that we were in almost a year ago when we were thinking about SVB and everybody else?
From a balance sheet perspective, yes. The good news is we've seen this before. I think investors have a better idea of what to expect. As you said, there's a little bit of contagion from this bank yesterday, but it not quite the knee-jerk reaction that we saw in the spring, where you'd see a single headline out of anything and the entire sector was down 30%. I think investors are being, for the moment, a little more level-headed.
Explain to the audience, if you could, what is happening here at New York at the bank as it relates, on a relative basis to what was happening last year, because I think it's a different issue, but it, in a way, may even be a bigger issue because it could represent other issues for other banks.
Exactly agree. Last year, banks got in trouble being sort of stupid, slightly outside of their backyard, which is they got a ton of deposits during the pandemic when we all had a ton of cash sitting around. And some of them didn't really know what to do with it. Silicon Valley Bank and some others put it into super liquid treasury bonds and mortgage bonds and other things that we actually don't really need banks to be holding. If you and I want to own treasury bonds, we can do it ourselves. There's not a lot of social utility to banks loading up on that stuff. And they made a bad call on rates. They got surprised, in fairness, by something, the Fed doing something it had never done before, which is raising rates from 0 to 5 in 15 months. This is more concerning to me because this is what we need banks to be doing, which is to say financing illiquid real estate. That's the problem here. It's the commercial property market, which has been creaking for a while. Frankly, I've been surprised we haven't seen more of a reckoning. You go to your office, I don't know what yours looks like. I'm not in mine this morning, but your average office tower in a major city is half full on a good day. Today's Friday, it's probably 25% full. That's not a thriving market. Those things roll slowly, leases roll off slowly, tenants, gain bargaining power over time. But it's a problem here in banks' core business, particularly regional banks' core business, which is financing real estate. This is a credit problem, which makes me more nervous than a sort of stupid screw up on rates.
There was an expectation last year that there was going to be a massive wave of transactions, meaning mergers of some of these smaller community banks. We have not seen that so far. Why do you think that is?
It's mostly a regulatory overhang, I think. This administration is not particularly friendly to mergers, particularly to bank mergers. There's a little bit of sort of American psychology here. We have a lot of banks. We like having a lot of banks. There's 5,000 banks in this country. Right. There's, 5 or 10 or 20
like our local
in
banks.
Economies. What? Yeah.
We like our local banks.
We like our local banks. It's kind of like Congress. Everyone hates banks, but they like their local bank, and there's one on the corner, and it makes us feel good. We don't tend to like to see those disappear. I think it's misguided because, as we saw last spring, the government's going to be dealing with this problem. Ultimately, the M&A is the solution one way or the other. It's sort of politically easier to do it in a fog of war over a weekend when you say I had no other choice. But I think you really need to see some consolidation here because, separate from the real estate problem, what's really happened is that their margins have collapsed. These mid-sized banks, they're paying up for deposits that are a lot more expensive because you and I realize that we should be being paid for our money sitting in the bank. The rates on loans are going up, but not quite as quickly. And as you were just saying, there's some sort of economic pullback, particularly from corporates. So the demand for new loans, new business formation is down, is slowing. And so they have to pay for these deposits, and they can't quite deploy them in profitable loans. And so the spread on that business goes away. And, the solution to an industry where margins are shrinking is consolidation. And you're right, we haven't seen that here, but this is sort of an illogical market at the moment.
Hey, Liz, you covered a lot of ground with that. I mean, I've been trying to figure out how much of it is the regulatory oversight, which some of the banks are blaming, saying it's because they now had more than $100 billion in assets and had to pay up to all these things. How much of it is what you just talked about, having to pay more for the deposits as that went away? How much of it is the commercial real estate loans that we have to look at for these problems? And, I keep asking people, is this going to be akin to the SNL crisis that was out there? And I haven't gotten anybody who thinks that at this point, but they are watching for other banks to run into some trouble in those mid-tier banks.
One issue with New York Community Bank is they kind of declined to put a number on it going forward. Commercial real estate is a problem, but banks should know what they're holding, and they should be able to signal to the market, this is the size of the hit. Here's what happens, if defaults go to this level. Here's what happens if rates, at this time next year are 3.5%, whatever. A little clarity, I think, would be helpful on that. To your point, it looks a lot more like the SNL crisis than it does like the 2008 crisis, even though at the moment real estate seems to be the problem, which gives people, some PTSD flashbacks from the great financial crisis. But look, this I think is more, we'll see. And if the contagion starts to spread, it could start to feel panicky like it did last spring. For the moment, this feels to me like a slower moving earnings crisis. That's really just dependent on the spread game, what they pay for deposits versus what they can get for loans. Some of that is really rate dependent. Some of that is tied to the broader, economic growth picture. The other thing I'll say, though, is, I think we've seen Silicon Valley Bank, First Republic, those were really good banking franchises. They had good clients. They had talented bankers. They had real business. And so they were attractive to other bank buyers. Ultimately, I think the further down you go onto the regional and really sub-regional ladder, you're really talking more about asset sales. There aren't a ton of people who are going to want a lot of these smaller banks or be able to move over a weekend on them. I think you're going to end up with just a lot of these portfolios being sold.
Right.
And there's a floor here that there wasn't in 2008, which is there's a lot of people who aren't in real estate who've regretted it for the last 10 years. A lot of private equity firms never made the jump, and this is a pretty good entry point.